All right, let's jump right in. You've probably seen it everywhere. The big financial headline that's got everyone talking. The Dow Jones just smashed through 50,000. I mean, wow. That's a massive psychological milestone, right? On the surface, it feels like the ultimate proof of a booming market. But is it really? And hey, you can't blame anyone for celebrating that, right? 50,000. For a lot of folks, that number feels like total validation. Proof that the post-pandemic recovery is for real. It feels like the good times are not just back, but maybe even better than before. But, as we're about to find out, there's a really fascinating and honestly a kind of worrying story hiding just behind that big shiny number. Because here's the crazy part. This central paradox, while the big index is hitting these unbelievable new highs, a ton of individual stocks are actually getting absolutely hammered. I mean, we're talking crash-like drops. So what in the world is going on? How can both of those things possibly be true at the exact same time? Well, that's the puzzle we're going to piece together today. So to really get what's happening, we've got to look past all that confetti and the screaming headlines. The analysis we're digging into here argues that the market's internals, what's happening under the hood, is telling a completely different story from what you're seeing on the nightly news. And this really gets to the heart of it. We're seeing what some are calling a huge divide, a great bifurcation in the market. You've got the big, famous indexes like the Dow getting dragged higher and higher by just a handful of giant companies. But at the same time, the average stock, the vast majority of the market, is actually struggling, or in a lot of cases, even falling. And this isn't just a feeling, the numbers are pretty stark. Get this, in just the last few weeks, about 115 different companies in the S&P 500 have had a single-day drop of 7% or more. That's basically a mini crash for each of those stocks. That level of volatility happening inside a rising market is a massive red flag that things are maybe not as solid as they look on the surface. Yeah, there's actually a technical term for this whole phenomenon. It's called poor market breadth. All that means is you have a rally that isn't being supported by most of the stocks. The analogy here is perfect. It's like an army where a few generals are charging ahead, but most of the soldiers are actually retreating. And historically, that is a classic warning sign of a really fragile market. Okay, so if the average stock is struggling, the big question is, why? What's causing it? Well, the source material points to a silent but incredibly powerful force. Money, or liquidity, is quietly being pulled out of the system. And it tells us to look at a very specific and maybe for some a surprising place to see it happening first. And that place is Bitcoin. The idea here, which is a really powerful metaphor, is that Bitcoin is like the canary in the coal mine for liquidity. Because crypto assets are so sensitive to the amount of speculative, risk-taking money in the economy, they tend to act as an early warning system for everything else. They feel the changes first. Let me break that down a little more. The key point is this. When big traditional stocks get into trouble, there are often safety nets. Think of things like the Fed put or government spending. But crypto, it doesn't have any of that. It runs purely on private money, investors willing to take a chance. So when that flow of speculative money starts to dry up, crypto is the first to feel it, long before the traditional stock market even gets the memo. And here is the hard data. This isn't just a theory. Take a look at these flows from the spot Bitcoin ETFs. This is not a small trickle, folks. We're talking about billions of dollars flowing out. Over the last 5 weeks alone, that's almost $4 billion gone. Year to date, it's $4.5 billion. That is the canary, and it is singing a loud, clear song that the environment for private, risk-on money is getting tough. Okay, wait a second. If all this private money is drying up, why on earth are the big indexes like the Dow still rocketing upwards? And that brings us to the absolute core idea of this whole analysis. The argument is that we're in a totally new economic game, one that's being driven by a playbook called modern mercantilism. So what is that? What is modern mercantilism? Put simply, it's when a country's national security goals start to dictate its economic policy. Governments, not just in the US, but globally, are basically deciding that key industries, think AI, defense, semiconductors, are just too important to be left to the free market. They're essential for survival. So they're stepping in and pouring massive amounts of money into them, creating what is essentially state-sponsored demand. And this new playbook has some really specific effects. First, it creates demand that is totally insensitive to price. The government needs it, so the price is secondary. Second, it unleashes this giant build-it-and-they-will-come spending spree. The government is basically giving these companies a blank check. And third, and this is crucial, it reshapes the entire economy into a barbell. You get a huge boom for these chosen industries and stagnation, or worse, for pretty much everyone else. And this right here is the absolute key. It's a fundamental change in mindset that's driving all of this. For governments and for huge corporations, the risk of underinvesting in something like AI is now seen as a much, much bigger threat than the risk of overinvesting. The fear of getting left behind in this new global competition is so great that it justifies basically any amount of spending. And that is what's opening the floodgates of capital into these very specific areas. So let's connect the dots. What does this all mean for the markets? What does it mean for the economy we're all living in? Well, it's created what you can only describe as a tale of two economies. So on one hand, you've got what's being called the story economy. This is all the AI and defense stocks, the industries fueled by this river of public government spending. And they are absolutely booming. But on the other hand, you have the real economy. This is the stuff that depends on you and me, consumer goods, cyclical businesses. It relies on that private liquidity we talked about. And as we saw with those Bitcoin flows, that well is starting to look awfully dry. This table just lays it all out so clearly. It's basically two completely different ways of reading the market. The mainstream view looks at the Dow at 50,000 and says, bull market. This new read says, nope, it's a nominal illusion. The mainstream sees Bitcoin hovering around and thinks, neutral. This framework says that's the liquidity canary screaming a warning. It just goes to show how putting on a different lens can completely change what the data seems to be telling you. And that brings us to the big final takeaway from this whole analysis. The market we're looking at today, it isn't pricing in some broad, healthy, organic economic boom. No. What it's actually pricing is the cost of a massive state-sponsored project to completely recapitalize and accelerate America's most strategic industries. So I'll leave you with the same big question that this analysis leaves us with. Is Dow 50,000 a sign of a real productivity boom, a genuine AI-driven leap forward that's eventually going to benefit everyone? Or is it just an illusion created by the monetization of national security, with the stock market just being used as a tool to get the job done? That is really something to think about.